Hey, what's up guys? In this video, I'm going to look at my small cap stock pick of the month at Home. So this is a smaller company. It's a retailer. They sell home furnishings and things like that. As usual, I'm going to do a financial statement analysis on the whole company. Going to use an intrinsic valuation model and try and figure out whether it's a good deal or not. If you're new to the channel, hit that subscribe button to check out more stock analysis videos like this one. Alright, let's jump into it. So alright, this is at Home. They sell everything you would need for your house. They got pillows, you got rugs and curtains, wall decor, kitchen and dining, bedding and bath. They got stuff to help you store your other stuff, outdoor living stuff. Alright, so here's a quick look at their stock. It's up about 300% in the past year, but it's still only trading at about 11.3 times next period's earnings. It's a $1.62 billion market cap. And what's very interesting here is that the short interest is about 23%, which is very, very high. So a lot of people are not believing in the stock. Let's see if that has any merit to it. Let's examine this stock. This is the part of video where I normally dissect how the company makes money, but for them it's very simple. Their financial statements simply tell you it's 100% from their retail stores there. And as far as where they generate revenue, they are a 100% US company. Here is their balance sheet. They are a little on the high side on their leverage. You can see the 83% liabilities-to-assets ratio. Current ratio is above 1, and for a retailer, that's all I need to see. I like that. But have a look at that quick ratio there, 0.2. Very low there. That means that their current assets, if you take out inventory, are not able to cover their current liabilities. So they could run into a problem here if people stop buying their stuff. They're not going to be able to cover their own liabilities. Interest coverage ratio of 6.55 is also a little bit low. I really hope they can grow their earnings. We're going to have a look at that to see how likely that is, because right now that interest expense is eating up about 1/7 of their profits. And they are pretty long-term asset intensive. So it's not the healthiest balance sheet, and it really is only going to make sense if they're growing. One positive indicator I do like to see is that their days in inventory is trending downward. This is the average number of days their inventory sits in their stores before it's sold. So you see it was around 152. It's now down to 129. Still high, but it's trending downward pretty significantly. That's a good indicator going forward. Another good indicator is that they have spent quite a bit on capital expenditures around 2019 and in 2020, still spending a respectable amount there. They haven't really been spending as much in the trailing 12-month period there, but these investments should pay off going forward. That overall to me is a positive signal. Another thing they're doing is investing in human capital. So again, as they make these CapEx decisions and these hiring decisions, that is a good signal. They certainly believe they're going to be having more sales. They're opening the stores. They're hiring the people. So you got to take those as pretty good indicators. The company has pretty impressive, if not, astounding, revenue growth. So not up there with some of the tech giants that can grow their revenue at 30, 40, 50% there, the Teslas or whatever. But, pretty consistent, pretty solid revenue growth. And, coming from a company with a market cap of $1.6 billion, this company still has a lot of room to grow further. Alright, so the past 2 years, the company's reported net losses there in 2020 and also the trailing 12-month period here. What is going on here? Because when you look at their gross margin, it's actually shockingly consistent. It's coming in at close to 32% there. Very good. For every dollar of sales they have, about 32 cents is left over after paying for the actual cost of the product. including any labor to assemble it. That's very good for their industry. In fact, their operating margin is very good, coming in at a very consistent, I'd say about 10% there. So where is the money going? Because these big net income margin losses here the past 2 years, well, that's going to be an accounting thing. When you have very positive operating margins, you get positive operating income there, but you end up with negative net income, it's usually due to what we call below the line expenses, some kind of unusual item there, one-time restructuring charge, an unusual loss, something like that. Now, because they've done this for the past 2 years in a row here, I have to wonder, how unusual is it? That would be my only concern with investing in this company. Don't make it a regular thing, okay? Alright, so here's that DuPont analysis for this company. Their ROE is not that great here, obviously being negative in the last 2 years because of those accounting write-downs. But even when it was good, it was only about 8% tops there. Again, even in their good years, like most retailers, their net income margin was, anywhere from 3 to 4%. So not that great. I'd like to see their asset turnover go up, and it is trending upward here. And honestly, it will go up. As you open new stores, you're going to have pretty low asset turnover because those stores just opened. They haven't had the full year to generate sales. So while they're still counted as assets in your balance sheet, they're not really helping you generate sales yet. I foresee that going up going forward. The equity multiplier shows the effects of leverage here. And they have levered up quite a bit, as you can see. But look at it this way. If they're able to get asset turnover to even just 1, and they're able to get net income margins of 4%, with leverage they have right now, that would translate to over an 18% return on equity. Okay guys, so at this point in the video, we're going to try and come up with an intrinsic value for at home. I'm going to use the free cash flow to equity model because they don't really pay any dividends, so a dividend discount model wouldn't really do very good here. So to make the model work, we need to obviously have a discount rate to discount those cash flows back to present value. Given their balance sheet, given the age of the company, I think a pretty high discount rate is in order here. I would go with about 10%. I think 9 could be okay, maybe 11. I don't think any lower than 9 would be alright though. As far as the growth, we have a lot of data indicating some growth coming up. We also have analyst forecast data pointing in the same direction. We're going to take kind of a combination of those estimates and come up with a pretty good estimate of growth. And as always, I'm going to show you how the value would change if those growth estimates were a little bit different. After 5 years, we're going to have a terminal value. We're going to assume free cash flows can only grow at some kind of nominal rate after that, just to keep up with inflation. We'll go with about 2%. So we're going to put that all together and let's see what the company's worth. Okay, so what we're looking at here is a valuation matrix. Each cell is the fair value of at home for a given discount rate and a given growth rate in free cash flow to equity over the next 5 years. Afterwards, we're going to assume a perpetual growth of 2% per year for all the cells. So which cell is most likely? Well, again, I'm a bit more cautious. I'm going to use a 10% discount rate given their balance sheet and the age of the company being young and uncertain. And as far as the growth rate, analysts and past experience all point towards kind of a modest growth rate here. So I think probably this cell right here could be the most likely, making it worth about $24.71 today. But I have all the cells up there so you can analyze it and put your own assumptions in if they're a little bit different from mine. So what I see here is it's not really a good deal under the higher discount rate scenarios. Another way of interpreting this is to look at this as a required rate of return. So for example, if I want an 11% return on my investment and I think they'll grow at 5% per year, I have to pay no more than $20.26 per share. So if you look at the matrix below here, it's a bad deal if you're looking for 11% return or a 10% return. which for me is what I would want, a 10% return given the risks. If you're willing to accept an 8% return, yes, it's very undervalued under those assumptions there. Personally, I think that's too low a rate given the risks the company faces. So here's some insider trading activity data for Home. And I see there's 4 insiders buying in the past 3 months and 3 selling. Let's look at the number of shares involved in these transactions. And we see here there are much more shares being sold compared to shares being bought here. You get about 21 million shares sold, about 600K shares bought. Overall, I would view that as slightly negative. The reason I use the word slightly is for 2 reasons. One is that insider selling is just generally not as informative as insider buying. At some point, all insiders want to cash in and sell their shares. They're all granted some amount of shares of their own company. The other reason I would say it's only slightly negative here is that their share price has pretty much quadrupled in the past year. A lot of reasonable people would choose to sell at this time. Alright guys, so here are my final thoughts on At Home. Well, it's a very interesting company. I want to thank the person that recommended that I analyze this company because it's very interesting. They are a new retailer. It's a very competitive space and they're smaller. They can't offer the kind of discounts you might be able to offer at a larger retailer. So they definitely face a lot of risks in this area. They've gone and borrowed a lot of money. I don't love their balance sheet ratios. That makes them risky to me. Counterbalancing all of this, they're pretty much trading at about 11 times next period's earnings for a company that's expected to be growing. Now, not growing tremendously, but growing nevertheless. So it looks very attractive just based on the PE ratio. And when we plug everything into our free cash flow to equity model, it still looks pretty attractive at lower discount rates. But again, I personally think there's so much risk here. That's why you got 23% short selling ratio. I just don't see that the compensation for that risk is great enough to want to invest in the company. So for me, I'm going to pass on it, but it's a very intriguing company and it's one that I'm going to keep my eye on. So thank you guys for watching. If you liked it, hit that thumbs up button. Really helps the channel. And let me know in the comments what you think about this stock.